You're syncing up and tuning in to the Lending Link podcast, powered by GDS Link, where the modern-day lender can dive deeper into the future of data, decisioning, and credit risk solutions. Welcome to the show, everyone. I'm your host, Rich Alterman, and on this episode of the Lending Link, we're sitting down with Frank Tian, a credit risk specialist and author of the book Unsecured Lending Risk Management, who is currently a risk lead with H&R Block's mobile banking platform, Spruce. Frank has worked for over 2 decades at multiple banks and non-bank institutions in the U.S. and Canada. Frank's work has spanned the full spectrum of retail risk management, from credit strategy and risk modeling to credit systems and loss forecasts. Frank holds a Master's of Economics from the University of Ottawa and a Bachelor of Science in Finance and Banking for the Northeast University of Finance and Economics in China. In this episode, Frank and I are going to spend some time talking about his book, differences in the lending market between the U.S. and Canada, changes in the lending landscape over the past 2 decades, and so much more. A link to access Frank's book can be found in the podcast show notes. But first, please head over to GDS Link's LinkedIn and Twitter pages at GDS Link and hit those like and follow buttons. And please be sure to subscribe to the Lend Link on Apple's podcast, Spotify, or wherever you prefer to listen to your podcast. All right, now let's get synced with GDS Link. Good afternoon, Frank, and welcome.
Oh, thank you, Rich. Good afternoon.
And where are you joining us from today?
Today, I'm joining you from the Great White North, the home to Raptors and the Maple Leaf, Toronto, Canada.
Okay. You have any snow on the ground up there today?
Just a little bit from last 2 days. Has been a warm winter so far. We don't have the outdoor rink set up yet.
Before we get started on the business side, I always like to ask my guests a personal question. And I understand that you're a poker enthusiast, enjoying Texas Hold'em and other variants. What got you started in poker, and how do you feel your mathematics skills have helped you at the poker table, or have they?
Yeah, how I got started, that was probably in early 2000, 2003, 2004. The WPT, they published a few episodes on TV featuring their final tables of several large tournaments. So they leveraged the technology at that time. It's really, they put a small camera so in the reel of the poker table, so right, you can see the whole cards of players. So that was the first time people can get inside of the players' heads, what's their strategy, how they approach that. So I find that's very interesting. The game didn't seem too hard. I got caught on with many peers at that time. Depending on your goal, am I going to have fun today with friends, or this is the group that they are friendly, I want to sit down with them. And also for tournament, right? So some tournaments, the house just takes too much risk. Some tournaments, they offer you slow structure so you can better showcase your skills. I think that's a good decision you want to make before you even start the game.
Right.
So I think it's still a fun game. I don't get to play too often these days, with family, work, but still maybe a few times a year, got together with a group of friends, play over the beer. That's fun.
Thinking about Texas Hold'em, where you have the cards down, face down, that you don't know what they are. As we think about digital lending, right? It's the same type of thing where I don't know what that consumer really looks like behind the screen. And I need to incorporate different products to make sure that that person really is who they say they are, and make sure I have the right tools. So we'll talk about that a little later. So thanks for sharing some of that insight. The fact that you're still sitting here with me today tells me that you may not be a great poker player, because otherwise you'd be off and doing your own thing. But let's get started by talking a little more about your career. I just touched on what you're doing today, but you've been in the space for 20 years now. Can you just share some of your background, maybe some of the companies that you've worked for, and maybe also talk about some of the challenging projects that you've had in your career that you look back on them, you're proud of what you really accomplished?
So I started my career as a risk analyst with one of the oldest retailers in Canada called the Hudson's Bay Company. It's actually older than Canada itself. At that time, many retailers, they still own their own credit card portfolio.
Yeah.
Just remember, credit card starts with retailer, right? So basically, it's
Absolutely.
a plastic IOU receipt. Then before the subprime crisis in around 2005 and 6, there was a trend in the industry. The banks, they approached these retailers saying that let us help you. So we are doing this for a living. We know how to lend. We have the cheap funding, so our cost is really low. You do what you are supposed to do, merchandising, so sell the best merchandise to consumers. We'll share the revenue and profit. So that seems quite a good proposal at that time. That's the reason all the big banks, they bought up all the major credit card portfolios in the US and Canada.
Right.
So I move on with the portfolio into GE Money. That's
Okay.
today's Synchrony. So worked there for a few years. Then the subprime hits. Then GE exited Canada. I move on to work for a couple of full-service Canadian banks, CIBC, BMO. There I got to learn other lending products like lines and loans, overdrafts. Got to see how lending products fit into this full-service customer relationship, right? So in the banking model. In 2015, I decided to explore a different market, broaden my horizon. Naturally, US is close, very similar to Canada in culture, but yet different. So that seemed to a natural choice. So I worked for Wells Fargo for less than 2 years, then Union Bank of California for 5 years, and most recently with H&R Block, helping them launch their new bank platform, Spruce. In terms of the challenging projects, I think every experience has its own unique challenge. For example, at Wells Fargo, I worked for their retailer portfolio, right? So the challenge at that time was to how do you make sure that the corporate function, they can view this dynamically fast-growing portfolio and understand that, right? So the bank was also building the three lines of defense, but you have a 7 billion portfolio with 30 to 50 different retailers in furniture, jewelry, house financing. So it's very different than managing a 7 billion bank card portfolio. It's an interesting experience to build some framework out there, some dashboard to help the corporate executive to really understand that clearly and in time.
Let's kind of get down to business now. And, as you know, my initial catalyst for reaching out to you was a result of my having read your book, Unsecured Lending Risk Management, A Practitioner's Guide. As someone who's been in the credit industry for 40 years now, I feel the book does a great job of really laying out a foundation for understanding the full credit lifecycle of lending and credit risk management. A couple of things. Number one is, can you share what made you decide to write the book, how long it took you, and what did you learn about authoring a book like this along the way? But I am going to give you an opportunity first. I have the book right in front of me. You dedicated it to your grandmother, your great aunt. Maybe you could just give us a real brief on why you made the dedication to her.
When my father was young, around 4 years old, his biological parents, right? By my biological grandpa, grandma, they got sick with a regional epidemic. Unfortunately, they passed away at a young age.
Sorry to hear.
So then actually my father's uncle, his dad's younger brother and wife, took him and his sister under their wings. Then they grew up with them. So in my book, this is a great aunt, right? So it's really she's my grandmother when I grew up. So I spent a lot of time with her, with my other uncle aunts, so with my cousins. It's really a big family. And I wrote the book during the pandemic, right? So I think it's the same thing. The human being, we live through this crisis time over time. But if we really work together, so care about each other, that's how we carry through this. Just because of the timing, just because of the way I grew up. So I dedicated the book to my great aunt, which I called the grandmother. So yeah, unfortunately, right now she's battling with COVID. Right now,
Yeah.
you might know that there's a big wave hitting the China right now. So I'm sending all the prayers to her and all the family members there. Hopefully, they all recover soon.
You mentioned working for Wells Fargo, so we know that you've worked in Canada and the U.S. We have clients at GDS in both Canada and the U.S., and there's obviously some nuances. In fact, Quebec just rolled out the requirement to be able to freeze a credit report. They've been doing that in the U.S. now for quite some time. I was actually surprised that it didn't exist in Canada. So when you think about, and of course in Canada, you have Quebec versus other parts of the country, and there's some differences there as well. Any interesting tidbits, highlights when people think about credit in the U.S., when they think about credit in Canada, where there may be some things that are really different in the approach, or are things more the same?
Yeah, these two markets are very similar, but yet there are differences. I will maybe highlight a couple of things. The US market in general is very competitive. I think it has something to do with the fact that there are just more financial institutions, right? So 4,000 banks, 5,000 credit unions, many fintechs. Versus Canada, when you look at most financial categories, they are dominated by the big five Canadian banks.
Right.
But of course, there are some other players and the fintechs in recent years. And also the legislation is different. For example, in the US, you can do print screen. So I can target other customers, right?
Yep.
So approach them. Versus Canada, you cannot do that. So that's the reason in Canadian banks, they focus a lot on the cross-sell to their internal customers.
Interesting.
Yeah, Quebec, you mentioned that it's different. 22% population. It's always a province that very pro-consumer, right? More progressive. You have to treat that province always differently. Also, the language is different, right? So, yeah. So I think as a result, that I would say this is on the relative scale. In the US, you might see some more aggressive business behaviors. Take overdraft, for example. You used to see the fee up to about $30, right? So compared with the Canadian banks, they charge $5 plus 18% APR, which is more reasonable. That's the reason, last year all the U.S. banks face the pressure from the challengers, consumer advocacy, and even regulators. They begin to lower that fee. I think it's a good thing for consumers, right? But again, overall, I think both markets, they have their good things. We can learn from each other. Especially in recent years, I'm glad to see their businesses, capital, talents, they move across borders in both ways. I think that's a good thing, right? When you look at other industries, performing arts, professional sports, you have some good result as for that. One example I like to tell people is that in 2019, Toronto Raptors won the NBA championship, right? But when you look at the roster, it's basically a team of American players. In the same year, St. Louis Blues won the Stanley Cup. So that's a bunch of Canadian players. So, so you are able to generate some pretty impressive results when you combine the best from both countries.
Any thoughts on why they don't allow pre-screen?
Yeah, that's a good question. Maybe they just want to build the barriers. Let's not waste time, resources on each other, pushing back and forth, right? So that could be thinking. I'm speculating here. Yeah.
Interesting. You've written a book. You've been in the space now for 20 years. I've been in the space now for 40 years. And this is a question that comes up on several of the podcasts. And, often say to people that when we look at underwriting in general, the process of underwriting really has not changed in the last 40 years that I've been in the industry. Fundamentally, you're making a decision about a person. You want to make the right decision, and you want to make a profitable decision. So, when you think about what you've seen in the last 20 years, what would you say are some of the most significant changes, and have they all been for the good, or have there been some changes maybe that haven't been for the good?
Yeah, if I look back the past 20 years, I think there are two trends I would generalize. First one is this disintegration. When you look at the global banks, they are gradually exiting that stage. For example, Citibank, they exited from a dozen international markets. Then within the US, you have, for example, MUFG just sold the Union Bank. In Canada, you have HSBC sold their Canadian franchise. It just becomes harder to operate everywhere. It's not applicable anymore. Another example is that you see the booming of fintechs, right? So they started as a niche player, focusing on some pain points in deposit, lending, or payment. They could grow up to something big, or even being small, but collectively they're taking some market shares, right, from incumbent banks. The result is that you see many more players, participants, right? The market becomes more disintegrated. At the same time, I would say a reversing trend also happening, right? So I call the reintegration.
Okay.
Because when the global banks, they left a certain market, some people will pick up what they left with, right?
Right.
So like US Bank just picks up the Union Bank, and RBC in Canada picks up HSBC Canada. So because those franchise, the branches are still very valuable assets, right? So
Mhm.
people want to meet with some financial advisors, talk about the important decisions. I think that interaction is valued more after pandemic. And also the banking in general is a business of scale, right? It take you, for example, 15 people to manage a 1 billion portfolio. When that portfolio triple in size, you don't necessarily need to triple your staff by
Right.
3 times. Another example is you see the fintechs, especially given current macro environment, many realize they cannot survive on their own. So they're looking to consolidate with each other and form partnership with other banks, right? So it's really it's a marriage of the best of the two, right? So
Right.
fintechs being nimble, they can leverage technology, doing the underwriting. The banks can offer the cheap funding. It's basically reintegrate certain components, right? But not
Mhm.
under one roof. It's under two
Multiple
roofs.
risks.
Yeah,
Right.
or multiple roofs.
Yeah.
Yeah.
It's
So yeah, I think that's two trends that are driving our ecosystem so in different directions right now. So
now it's interesting you mentioned the value of the branch network. I mean, isn't that really something that's generational? Gen Zs may never step foot into a actual branch. So isn't the value of that asset going to be declining over time?
yeah, you could think that way, but meanwhile, you also see that some players before they didn't have the branch presence, they began to invest in certain branch like a Capital One, right? So they opened the Capital One Cafe.
Right.
So they even opened that up to non-customer. I think it's a great way to market the brand, right? To people, even you are not my customer, but at least physically I exist. So
Mhm.
that creates an impression. So on this brand, and hopefully at some point of time, you can use my products and services.
So you talked about the banks and you talked about fintech. So that's a nice segue into banking as a service, right? It's obviously a hot topic right now. It's interesting if I were to talk to a couple different people and say, what is banking as a service? I'm going to get a couple different answers. So what would you consider banking as a service and where do you see that going as we move forward the rest of this year and beyond?
First, banking as a service, to me, it's a business model, right? So you have some non-bank entities, could be fintech, could be a retailer, could be a e-commerce platform, but they want to offer certain financial products to their consumers, right? Then the way they do it right now is they partner with a regulated bank. So the bank can stay behind the scene and do all the compliance, risk management stuff, right? Then offer the product and services through these non-bank entities
Mhm.
to consumers. The way I look at this is just the modern version of retail credit card, right? You and
Okay.
me, we both are very familiar with. Back in the day, the difference is that the banks work with retailers, the banks manage everything, right?
Mhm.
So retailer is purely upfront. But in the modern days, because of the technology advancement, some fintechs, they try to do some of the work, origination, for example, on their own. Okay, so that's the reason you see some variant in some bank fintech or bank non-bank partnerships. The bank does a lot. In some cases, the other party, the non-bank entity, they do a lot of things. So that's still no standard model yet. But the question is, does everybody understand what they need to do, right?
Right.
So can they build a consensus about what you do for each other and make sure that all the right things are being done? So that's certainly the concern from regulators or even as an industry observer. I can see that some banks maybe they just offer their balance sheet as a parking lot, right?
Mhm.
They don't do anything. They just let the financial products flow through. So that's definitely not what we want to see, right? So we still
Right.
want the bank you should do what you are supposed to do, right?
Mhm.
That's your portfolio. Then you have seen that the regulators they finally pay attention to this issue. Last year, you have a restrictive agreement between Blue Ridge and the OCC.
Yeah.
So people were questioning, oh, does that mean that OCC wanted to get into the day-to-day operation of a
Mhm.
fintech company or a bank? So I don't think so, right? I think that's just a precedent set by the regulator. But again, when you heard the speech from OCC chief, the report from the Treasury right after, right, on the bank non-bank partnership, even the two Fed officials from both the Democratic and the Republican parties, they have the consensus on this issue. They don't have a lot of consensus on many issues, but they know that we need to do something about this bank non-bank partnership, make sure they are under the proper regulatory framework.
Having worked for Teletrack, the first subprime credit bureau, several of the clients there had adopted the bank model, and they had partnered up with banks, and then you had that get adopted within the market fintech space, right? So there's always that concern: are you simply renting a charter? Certainly, those relationships benefit, right, from the fact that a lot of these banks have older legacy technology, right? It's harder to pivot. A lot of people call it technical debt, where the fintechs are able to bring more current technology to the table, right? And that fintech is maybe a broad definition, right? GDS Link, we're not a lender, but one might consider our technology, right, is a fintech like, if you will. We obviously work with a lot of the fintechs, and we work with banks. Yeah, it's going to be interesting to see how those relationships continue to evolve. And another hot topic today: buy now, pay later. That's another one that's you can't escape. When we think about big tech getting into the banking space on the buy now, pay later, you have Amazon has a product, Apple has a product, PayPal has a product, Walmart just announced their partnership with one fintech, where they're rolling out a buy now, pay later. So, when we think about big tech, what do you see in the future as far as, Amazon, Apple, Facebook? Do you think that they're really going to aggressively get into the banking space, given the footprint that they have with so many consumers?
Yeah, that's definitely an important question to many people in the industry and outside the industry. I think today's big tech, because they grew up with the digital information of every consumer, so it's in their DNA to expand their business lines into consumer finance. They have that internal drive. But however, when you look at strategically, it might not make sense further, right? For example, Google at one time wanted to launch their checking account. They even signed an agreement with a dozen banks. But 2 years later, they realized that, by opening accounts for some banks, I will piss off some other banks who will be using my cloud business.
Right.
So, and the cloud business is deemed as a major pillar business for Google. So then decide, okay, it's not worth it. So they gave up that checking account project, right? So Facebook, they wanted to launch global coin, right? The Libra 3 years ago. I don't think Mark Zuckerberg realized that literally issuing a global currency and competing with all the central banks.
Right.
So that was a no-go from the very beginning. So
Yeah.
I'm even surprised it took that long for Facebook to realize that. So they downgraded that global coin project to a US stable coin, but even that didn't fly, right? Because as a financial service institution, you need to have that trust from consumers, from regulators. Just because the Facebook's record, it was so bad, they had to change their own name, right, to Meta. They essentially given up that project altogether. So I think these are examples that the big techs, they are very capable of doing a lot of things. But should you do it? Only because you can do it, right? So are you trying to cover every business on the planet? I don't think so, right? Also, when you look at Apple, they are entering the buy now pay later space. I'm not sure it's a good move because they are using their own money to lend, right? Put on their own balance sheet. But as a tech company, their current return on equity is very high. So a banking industry, the return on equity is very low, right? In the teens. So tech company, you can earn 4 times the return on equity. Shouldn't you focus more on inventing more great tech products, right? Because I don't see Apple keep releasing different size of an iPhone, every year. I want to see something new, right? So I think the big tech definitely, they have the capability, but again, I think from a strategic perspective, I'm questioning whether they should be in this space.
Interesting. I mean, analogy there would be even for the fintechs. If you think about when they were starting up, they had the buy versus build decision to make, right? Do they partner up with somebody like a GDS Link for decisioning, or do they build their own? And I think you had a lot of debates between the technical group saying, hey, we want to build it ourselves. Won't that help our long-term value as a company because we own our own IP? Whereas the business side is saying, yeah, but if we wait for you to build it, right, it's going to be another 3 or 4 years. And let's do what we do well. And building risk management technology may not be what we do well, right? So we deal with that all the time at GDS is, build versus buy. And, there's a lot of good studies out there that show the value of one over the other. We're living in some very interesting economic times. It's hard to believe that a dozen eggs right now are costing, I saw the other day, I think it was 18 eggs for $8. A year ago on sale at Walmart, 12 eggs was only 24 cents. So the economy is putting a tremendous squeeze on people. Obviously, gas prices are coming down, which is helping. I think we're going to start seeing a softening of the housing market. I think the layoffs we're seeing are going to be more of a white collar phenomena in 2023. But now we just came off the tail of the pandemic, which was, we saw a tremendous pullback in the early starts of the pandemic. So if you were giving advice to lenders and thinking about where we may head in 2023 and thinking back to the pandemic, do you feel things could get as bad as what we saw during the pandemic? Or do you feel that it's going to be less of a degree and we'll get through it without as many bruises? Before you answer that question, I was reading your post on LinkedIn. You made a comment about banks are accelerating their reserve building and inflation is maybe cooling off a little bit, but you wrote the signals are pointing to the increased odds of a soft landing. Okay, so with that in mind, I'm going to help feed you your answer a little bit because obviously you're saying that things may be okay over time.
The bank's earning report just out last week. So one thing I look at is always the speed they increase their loan loss reserves, right? The allowance. So right now, I think the headline always paint, the recession coming, big layoffs. I think that's the nature of the media, right? So only bad news makes news. But I think things are looking not bad, really. It's pretty encouraging. Then because we still have a very strong employment market, right? So you have 10 million jobs versus the 3 years ago pre-pandemic, that's 7 million openings all the time. Then the inflation is coming down, although slowly, but it's a point downward. That's good. And when you look at all the big banks, they have the best economists, right? So they have the best talents. They study this every day. They only adjust the reserve a little bit. So just back to the same level we had pre the pandemic. That's the reason I think we are probably going to be okay. And also because the economy is progressing gradually. It's not like a sudden we fall off the cliff. It's never like that. So with that being said, I think as lenders, we need to be prepared to deal with different scenarios. Of course, you need to have your own judgment. My view is that we are in a time that consumers, they need help. So especially for some, they need to borrow to help them go through this period based on your clientele, right? So based on your products, if there's a fit, you can help them. That'll be great, help you build that relationship and carry long term. At the same time, I think we have to be vigilant on what's coming, right? One thing we learned from a pandemic is that things could change quickly. It's almost like you can plan to a certain degree, but how you react to the current development, that's more important. As long as you have all the toolkits ready, you have your system, your programs ready, be able to handle different scenarios quickly. I think that's always recommended from a risk management perspective.
Yeah, and I think where there's a lot of opportunity for using tech, right, is in the collection space, right? So lenders can be smarter about how they collect, what counts to collect, how they optimize their finite resources of human capital, because it is getting harder to hire people. That's an opportunity for lenders to further exploit technology. Going back to pandemic and the current economy, one of my big fears, and you mentioned what's going on in China, right, is that we may see big hits again to our supply chain, right? And that's going to drive prices up, maybe even head back in the other direction. I think the Fed's talking about another rate increase, right, to cool down inflation. So time will tell, but my personal feeling is we still have some rough times ahead. hopefully we'll get through it this year. Let's talk a little bit about open banking data. Certainly, that been, I think, one of the big changes in the credit market. You look at companies like Prism, did a study where they showed that for Petal, they were able to increase the approval rate by 35%. So it's definitely helping the underbanked. And the US, we're seeing, strong adoption. What are your thoughts on how valuable open bank data is to complement traditional data? And also, are you seeing the same type of use in Canada as you are seeing here in the US?
I think definitely the open banking provides additional data for decisions, right? So if you can increase your approval rate by not even 35%, right? Just the 5% or even 2% for a large business, that translates a big impact to your bottom line. I think there's still a lot of use cases, not only for the smaller institutions, right? So right now the fintech, they use a lot of such solutions just because of their clientele, but even for the incumbent banks, right?
Mm-hmm.
So today I know many of them, they use their internal bank information, but also your customer might not bank with you. You can still use that to help your not only adjudication, but also for account management, line management, even collections, right? Just mentioned. There's the great use case, and I see the opportunities are there for both US and Canada. In Canada, there's also open banking solution provider like Flinks, similar to the Plaid. So they're also, I think that you want to see more companies, they're able to leverage that raw data, right? So from open banking and package that in a way that's easy to consume, right? Then feed it into the decision engine easily, like GDS Link or some other risk engines. I think that the opportunities are definitely there.
Yeah, no, it's definitely been a big lift, I think. And you mentioned collections. I think about settlement is a great opportunity to leverage open banking data, maybe where that person hasn't permissioned themselves on the front end, but you say, hey, you can participate in our settlement program, but you have to permission yourself into open banking so we can get a better view of what you look like. So before we wrap, any thoughts, any insights on what the banking environment or lending environment, more importantly, looks like in China? Anything you could share there that might be interesting to the audience?
Chinese market is interesting. So many people did not notice that in the past decade, they just went through a huge experimental phase. Almost they try everything, every kind of financial innovation in that space. Because the landscape is that their traditional banks very conservative, so that left a lot of space for the newcomers, right? And also at that time, the central government, they want to leverage the new technology, internet-based smartphone, to propel the growth of economy. So they were very open about the innovation in the consumer finance period. So I was actually a little shocked when I saw what's happening back in 2018 when I made a trip back to visit family and friends. The regulators, they are very careful. And also plus the pandemic. I think right now the lending environment there is pretty tight. But I imagine at some point in time, they have to open up again to provide the much needed credit to help the economy to flow again. Yeah.
Last question for you. Thinking about some of the younger audience we may have listening to our podcast, any career advice you'd give them as far as maneuvering through the financial services industry?
The way I look at the things you need to launch your career, there are three components. So one is the technical knowledge, one is the communication skills, and the last thing is the business know-how. So technology is like programming skills or accounting, financial analysis skills. I think as the young generation, usually they're in tune with the latest tools available. So they're okay there. Of course, they still have to put in effort to learn that. And the communication skills, I think in the US, Canada, the kids are growing up with a lot of training on that, right? So when I look at my son, he's much advanced in presentation compared to me back at that age. But the business knowledge, that business know-how, I think is something I would highly recommend the young people trying to put in time to study because that's not taught anywhere. And at the end of the day, you will be working in a particular industry solving the problem,
Right.
right? So it doesn't help much if you drive a flashy car, but you don't know where to go. I think that's part of the reason I read the book is also keep the young people in mind, because technology could change, right? So we have a new analytical tools, models, but the fundamentals, as you mentioned, Rich, really doesn't change that much. If one day we all go to Mars, so we all communicate with antenna instead of smartphone, as long as you land, so you should expect to pay that back, right, with interest. So the fundamental
Right.
doesn't change. Yeah.
Well, Frank, thank you very much for joining us today. This is Rich Alterman. We've been syncing up with Frank Tian, author and leader in the unsecured lending space. As a parting gift, Frank has been generous in offering a special discount on his Consumer Lending Risk Management Essentials course for Lending Link listeners. Head over to the show notes to find the purchase link for the course and be sure to enter GDS link at the time of checkout to receive a $50 off 25% discount. Thanks for listening. If you've enjoyed today's episode, please be sure to subscribe on Apple, Spotify, Google, or wherever you listen to your podcasts. And be sure to leave us a review. Follow us on LinkedIn and connect with us on Twitter at GDS Link. That's at GDSLINK. Have a question for the show or have a specific topic you want us to cover? Hit the link in the description to drop us a note. Thank you for lending us part of your day. Make it a great one.